Hey, today, let me tell you about Larry Williams, a guy who knows his way around trading. He took $10,000 and turned it into $1.1 million in just a year. That's like a crazy 11,300% increase. Now, if you're anything like me, you're probably wondering, how on earth did he do that? Well, I went snooping around the internet to find out the simple strategy he used to make those huge gains. Oh, buckle up, because I struck gold. I discovered the precise trading plan Larry Williams used to pull off those incredible gains. Let me tell you, Larry deserves major props for coming up with this, because it works like a charm. And guess what? I'm spilling the beans with all of you. Let's dive right in. The strategy behind those massive gains is none other than the LW volatility breakout strategy, LW standing for Larry Williams. Pretty straightforward, right? This strategy revolves around a key indicator called the Donchian channels. To add it to your chart, head over to the Indicators tab, type in Donchian channels, and select the appropriate option. Now, the Donchian indicator is good on its own, but to make it work the way we want, let's tweak some settings. Go to the indicator settings and change the length to 96. Next, head to the Styles tab and switch the line colors to red for better visibility. Here's a crucial detail. These settings are tailored specifically for the 5-minute time frame. Larry specifically used the 5-minute time frame for this strategy. If you're opting for a different time frame, it's advised to conduct your own testing with various indicator values. Now, let's take a look at the Donchian channels indicator on its own. It comprises 3 lines. The middle line serves as a mean reversion point for the market, acting like a magnet that attracts the price. This line can also help gauge the momentum of the chart. If the price is above, it's bullish. If below, it's bearish. Moving on to the upper and lower bands, these act as great support and resistance levels. Often, the price will hit these bands and bounce back. The upper and lower bands can also serve as breakout points. If the price breaks the upper band, there's a good chance it will continue heading upward, exactly how Larry employed it. But here comes a bit of foreshadowing. There's a catch to this strategy. Actually, it's more than a small problem. Let me break it down. Typically, you'd enter a long position when the price breaks the upper band, set your stop loss just below the middle line, and target a take profit that aligns with a 2-to-1 risk-to-reward ratio, securing a winning trade. However, here's the hiccup. If the market is consolidating and moving sideways, that's when issues with the strategy start cropping up. When the market is consolidating, the upper and lower bands tend to be very close together, like what you see here. This proximity makes them more susceptible to breaking even with a small move that lacks substantial momentum. In the end, this could lead to a false signal, resulting in a losing trade. To avoid this scenario, we need to find a way to filter out such low-quality trades and focus on those with significant movement. To achieve this, we'll introduce 2 more confirmation indicators. The first confirmation indicator we're incorporating is the LWTI, short for the Larry Williams Large Trade Index. Now, let's tweak the settings for the LWTI indicator. Change the period to 25. The higher this number, the more it focuses on long-term trends. If you're seeking confirmation for shorter-term trends, a smaller number is preferable. In my experience, 25 works best for the 5-minute time frame. Additionally, adjust the smoothing period to 20. For the final touch, let's add a simple volume indicator. I know, not the most thrilling, but it'll be a game changer in avoiding false signals. Adjust the moving average length to 30 in the settings. Head to the Style tab and activate the volume moving average, setting the color to white. This volume indicator will be invaluable in identifying when the market is truly backed by momentum and not just experiencing a small, insignificant move. Now, let's get into executing this strategy. Make sure you're on the 5-minute time frame. For a long trade, follow these steps. Step 1. Wait for the price to rise and touch the upper red line. Step 2. Ensure that the LWTI indicator is green. If it's red when touching the upper band, skip the trade. Step 3. Confirm that the volume bars are above the white line and also in green. This indicates that the market isn't consolidating and there's sufficient volume to justify entering the trade. And here's a little extra for you. Stay tuned until the end, and I'll share the secret trick to enhance the strategy's performance. All 3 criteria must align for you to enter the trade. Once they do, that's your signal to enter. Now, let's talk about setting up your stop loss. Usually, you'd place your stop loss just below the middle orange line. However, there are situations where this isn't ideal. For example, when there's a significant gap between the upper band and the orange line. In such cases, setting your stop loss at the middle line would result in a huge distance. If that's the scenario, consider placing your stop loss at the recent swing low instead. However, in most cases, you'll be setting it just below the middle line. After setting your stop loss, establish your take profit at a 2-to-1 risk-to-reward ratio. And just like that, you've got yourself a potentially profitable trade. Let's walk through a short example. First, wait for the price to touch the lower band. Check the LWTI indicator. It should be red. Confirm that the volume is above the white line and the bars are red. Once everything aligns, enter the trade. Set your stop loss just above the middle line and establish your take profit at a 2-to-1 risk-to-reward ratio. And voila, you've secured another winning trade. Now, let's get into the secret trick. Another minor issue I discovered with this strategy is its performance near major support or resistance levels. Take this example where all our requirements were met. Indeed, the price touched the upper band, the LWTI indicator was green, and the volume was above the line, all signaling a trade entry. We set our typical take profit and stop loss. However, this trade turned out to be a loss. Zooming out, we can see that all criteria were met, but right at a robust resistance level. Despite getting all our signals, the price bounced off this strong level, resulting in a losing trade. To address this issue, here's the secret trick. Use a higher time frame, like the 1-hour chart, to identify major support and resistance levels. Once you've marked them, avoid entering trades close to these significant levels. For instance, in the trade mentioned earlier, you would have skipped it due to the strong resistance level. What I found effective is entering trades when the price is breaking a resistance level and all indicator requirements are met. This indicates strong confluence and bullish momentum in the trade. Now let's talk about the benefits of this strategy. The Larry Williams LW volatility breakout strategy comes with several benefits that contribute to its appeal for traders seeking a systematic and disciplined approach to day trading. Impressive profit potential. One of the most notable benefits is the strategy's demonstrated ability to generate substantial profits. Larry Williams' own success story, turning $10,000 into $1.1 million in a year, serves as a testament to the strategy's profit potential. Clear and objective entry and exit signals. The strategy provides clear criteria for entering and exiting trades. Traders can rely on specific indicators and conditions, such as the Donchian channels, LWTI, and volume bars to make informed decisions. This helps eliminate emotional decision-making and promotes a disciplined trading approach. Risk management. The strategy incorporates a 2-to-1 risk-to-reward ratio, emphasizing prudent risk management. By setting a stop loss and taking profit based on this ratio, traders aim to maximize potential gains while limiting losses, contributing to a more sustainable trading approach. Versatility across time frames. While Larry Williams used a 5-minute time frame, the strategy can be adapted to different time frames. Traders have the flexibility to adjust the settings based on their preferred trading horizon, allowing for versatility in application. Additional layer with higher time frames. The incorporation of a higher time frame for identifying major support and resistance levels adds a strategic layer to the approach. This can enhance the robustness of the strategy by avoiding trades near significant price levels, potentially reducing the risk of false signals. Quantifiable indicators. The strategy relies on quantifiable indicators such as the Donchian channels, LWTI, and volume bars. This mathematical foundation provides traders with measurable data for evaluating market conditions and making trade decisions. Educational value. The strategy offers educational value for traders looking to deepen their understanding of technical analysis and day trading. By dissecting and implementing Larry Williams' approach, traders can gain insights into market dynamics and the importance of adapting strategies to changing conditions. In conclusion, pairing this strategy with basic support and resistance, or even supply and demand, enhances its effectiveness. Thanks for tuning in, and I'll catch you guys in the next video.